Hey guys, welcome back. It's Josh and I again today with a 2 week or so update because it's been a couple of weeks since we actually did our update, but a couple of things have happened during those 2 weeks that we wanted to touch base on today. And I've touched on a couple of these topics in videos, and a lot of you guys have reached out and had questions that I've pushed you off to Josh to answer those questions, or I've answered them directly via email or text or what have you. But I wanted to put a video together today to talk about United Wholesale Mortgage, UWM, offering what they're saying is rates as low as 2.5%. Because I mentioned that in a video, and a lot of you guys have reached out saying, hey, I want that rate. How do I find a broker who can get me that rate? And I pushed a lot of you guys off to Josh. And then Josh wants to talk about that. And in addition, this past week, we've talked about being able to refinance now that you filed for forbearance. Now there's stipulations with regards to that I've talked about in that video, and we'll touch on that a little bit more. But I'll put that question in front of Josh in a minute and let him talk about that. But before we do that, guys, if you're new to this channel and you like all things real estate related, whether it's finance, mortgage, helping buyers, sellers, homeowners with trending topics, do us a favor, hit that subscribe button below. I'll link to Josh's information below as well, so you can reach out to him. But with that being said, Josh, UWM, right? So I did a video. I mentioned 2.5% in a video because that's the headlines I read, and I read a little bit more on it. But clearly, that's not exactly what's going on. So let's talk about UWM, pricing, where interest rates are, and let you dive into that.
Absolutely. So UWM definitely won the press conference with that announcement because people are reaching out, people are asking about it. Everyone would love to have a 2.5% 30-year fixed rate. The reality is all they really did is lowered the lowest rate available on their rate sheet. As recent as a few weeks ago, 2.75, 2.875 would have been the lowest rate that you would really see on anyone's rate sheet. So with their program, it's a little bit interesting. Again, they wanted to create a product out of what is essentially just a feature. It's an interest rate. It's a feature of any loan, and they call their program Conquest. So if you haven't got a loan from UWM in the last 18 months, you qualify for Conquest, which is supposedly this spectacular, amazing pricing. One of the gentlemen who checked in from your last video when you talked about that, Jeb, we ran through the numbers. High 700s credit score. Low 60% loan to value, rate and term loan. That's going to be your absolute best interest rate for a borrower. And they were looking, we could do the 2.5, and it was about 2 3/4 points for that. So again, on a $3,000 loan, you're paying almost $10,000, right? Essentially, the way I like to tell it to borrowers is you're trading $10,000 of your equity for a really, really low interest rate. So a couple pieces of that are important is it's sort of a low note rate price war. As soon as UWM makes that announcement, we have 3 other lenders that within a couple days saying, hey, check out our low note rate pricing. And they're actually better, and they don't have the requirement that you not have received a loan from them. Didn't call it a product, didn't do anything, just said, hey, look at our low note rates. So for the guy the other day that UWM was at almost 2.8 points, I think 2.6 was the best that we had for 2.5. And for the most part, there's a reason why people don't pay a bunch of points for loans. It's because we're in a 40-year downtrend in interest rates, and we have not yet hit the bottom. You go back to 1982, other than some little, it's not a straight line down, but for the most part, rates have been going down for 40 years. About 20 years ago, people realized this and started doing no point and even no cost loans, realizing that if I think that at some point a 30-year fixed rate is going to be 2.5%, why would I pay 2 points to get it today? We want to get the lowest rate at low or no cost and position ourselves to be able to take advantage when rates do drop. And why do we think rates are going to go lower? There's a number of factors, but the biggest one, Jeb, you and I talked about this a couple of weeks ago, is that the spread between the 10-year treasury and the 30-year fixed mortgage is historically been 1.7 to 2%. 2 on the high side, 1.7 on the low side. It's been 1.71 going on the last 10 years. Right now, we're up closer to 2.7. So the 10-year treasury has been between 0.65 and 0.7% for the last month. If we were at our normal spread of even on the high end of that, of a 2% spread, your 30-year fixed should be at 2.6, 2.7% without having to pay a ton of points to get it. So if you're at 3.5% right now, I would probably keep my powder dry and wait until rates go lower. All the people that we're talking to that are at 3.875, 4 and an eighth, by all means, let's do a 0 point or even a no cost loan. Get as much of the benefit as we can right now, but still preserve all of our equity in case rates do go lower. And if we had any thought or perspective that we were at the end of that 40-year bull market in interest rates, then by all means, you might want to pay 2 points. So if we get to a point where we say, hey, interest rates at a certain point, anyone lending money for 30 years has to have a profit margin built in there. So there is a floor. Is that number 1.5%? Is it 2%? I don't know. So when we really think we're approaching that level, maybe you would want to pay a couple points. If it's your forever home and you can, map it out over 20, 30 years, the benefit can be there. I just don't like seeing people trade their equity when most people aren't in their loan and their home for long enough time to recoup that cost. So bottom line is we've got multiple lenders now competing in that low note rate space if you did want to pay points. And what I can say is no one was trying to sell points on loans 3 months ago. Now suddenly we're in coronavirus, rates are a little bit lower. I was talking to a friend of ours this morning, Jeb, a friend of yours and mine, and he's like, yeah, we're getting 2.75 on a 20-year. What are you paying? Well, I don't know. We're rolling it into the loan. It's like, okay, 2.75, but why are we giving up equity for that when there's a very good chance that whether it's 6, 8, 12, 14 months down the line, that we're going to be able to benefit from it without having to pay those points. And when I say that, I also want people to know I'm not saying if the numbers make sense today to not refinance, because we don't have the guarantee. What are the what ifs? What could happen? Home values can drop, can cause a problem in appraisals. The employment situation can worsen and people can lose their jobs, or one of the borrowers in the family can lose their job. And even the possibility that the economy recovers quicker than what we're all thinking right now. If the 10-year goes up to 1.25, great. Even if we normalize back to what that normal spread is, we're still only where rates are right now. So if it makes sense at a lower no cost loan to refinance today, absolutely do it. But if you have a good rate, I wouldn't pay a bunch of points just to have bragging rights to say I have the lowest rate on the street.
No, absolutely. And I did a video last week, which I'll reference to here, where I actually talked about refinancing. That was where I mentioned that 2.5% with UWM. But in there I mentioned, we don't know, like you just mentioned, where your employment's going to be. You might be stable right now with employment. Appraisals, home values right now are strong. That might change. Like you said, the economy. But one thing about refinancing that I tell everybody is that, you've got to make sure if you are paying points, if you are paying fees to do it, whether it's rolling it into your loan or whatever it is, that it makes sense, right? I mean, it's got to average out. I mean, if you plan on being in your house 2 years and you're only saving $200 a month and it's costing you $10,000 to do it, probably doesn't make sense to refinance, right? I mean, and the professionals out there are telling people that, right? They're not just going to refinance somebody to refinance. You're going to tell somebody, hey, look, this is what you're doing, and give them the option of doing that.
And not just telling them, Jeb, but putting it on paper. Right. Borrowers, homeowners don't deal with this every day. They need someone who can not just throw words at them and say, well, I think this or I think that. Numbers never lie. Put the numbers on paper. In a perfect world, I know I do a great job for my clients, so I don't want them to call 5 different lenders because they're going to get 4 pieces of misinformation, and I'm going to have to go through and bring them back and show them everything. But at the same time, the people that get, screwed, for lack of a better word, the most are the ones that just call whoever. They call the first person, and you look and you're like, wow, why did you pay $8,000 for a refinance that should have been free or should have cost $1,500? So it is important to just do a double check on the numbers. I'm not a person that thinks the absolute lowest rates and fees are the best deal for you, because I know who's offering the absolute lowest rates and fees. It's call center operations that advertise online. They've got 22-year-old kids in a call center that don't know anything. So it can work out well for you if you are a W-2'd employee, one borrower with an 800 credit score and a bunch of equity in your home. But for most people, they're bumping their heads with those lenders and having more trouble. So there's a balance there between a really good and competitive rate with an expert or the absolute lowest rock bottom rate with a kid in the call center.
Well, and that's the difference, right? I mean, working with a professional, they're going to, like you said, put it on paper. tell you whether or not it makes sense. I mean, you're not going to tell them what to do, but you're going to kind of give them advice. Whereas the guy in the call center is likely just trying to close the deal. Right.
Absolutely.
There's very little integrity. There's very little follow up after the fact. These are, it's a numbers game.
Well, it's funny. There's a guy that's actually a trainer in the real estate industry now, and he started as a loan officer at Quicken in their call center. And if you get his book, he basically goes through in the first 2 chapters everything they did to convert internet leads. And I'll give you a hint. It wasn't do an awesome job for the client. It was essentially keep them on the phone as long as you can. Get as much information out of them as you can so they don't want to start over and do it again with someone else. It really is about converting deals. They're measured. You received X number of leads last week. How many of them converted? What did we make on those?
Right.
Again, every business is in business to make money. We all want to convert as many leads as possible. But at the end of the day, our whole business is built around referrals from past clients, referrals from realtors. And if we're not taking a great care of you and doing what's right over the long haul, and sort of on that front, I meant to drop it in a couple of seconds ago. Probably the biggest mistake that I see people making is even if you're lowering your interest rate, a lot of times the sum of the benefit, if you refinanced 4 years ago into a 3.75 and we can get you into a 3.25 today, we need to be aware that some of that is your current loan is now a 26-year loan. We're comparing it to a new 30-year loan. So we can get you custom terms to keep it at 26 years because we want to keep our homeowners progressing towards free and clear home ownership or having a plan. If they're great savers and we say, hey, no, we're going to go back to 30 years and keep the payment as low as possible and have the highest savings because we're plugging it away into other assets where we'll eventually be able to pay off our mortgage. I just hate seeing this where we've had people for 10 years that, either they took cash out or they just 30-year loans that they're not getting the loans paid off and not progressing the way that they should be. So when you're comparing a loan, if someone's not showing you how much of that is due to extending the term and how much of it is due to the lower interest rate, it can be a little bit of a false comparison because some of it is simply just stretching it back out to a 30-year if that's what you're looking at.
No, and you said something that's important there. I mean, you said, this is all about referrals. And so basically to me, what that boils down to is relationships, right? So, you and I are both in California. So if you're in California and you're watching this, and you have questions, interested in maybe refinancing, you can contact Josh, right? He can guide you in the right direction. If you're out of state, we know people, both of us in across the U.S. that we can refer you to reputable people. So, and we get nothing from that, right? I mean, there is no referral business in the mortgage world. I mean, I get no referral fees by passing your name off to someone else. But what I do get is I get I know that you're being taken care of, and that's the important piece. So if you're out of state and you have questions and you want to be referred to somebody locally, reach out to either of us and we can guide you in the right direction there. I started off by talking about forbearance. Is it echoey at all?
A little bit, but it's not bad.
Okay, so we started off talking about how this week we came out with the ability now that you can refinance if you've been in forbearance, right? Part of the stipulations of that is that you've had to make, your loan has to be reinstated, which means that you either had to pay that lump sum payment, set up a repayment plan, gone into deferral, loan, whatever it is, it has to be reinstated, at which point you have to make 3 consecutive on-time payments. So right now, chances are nobody's even in the position to refinance because of when this started and they went in because the first month was March. So it'd be March, April, May, essentially. Now some people could have gone in and gotten right out of it immediately and made 3 consecutive payments. So even then, the earliest is probably June or July, at which point you would be able to take advantage of this. Now, I know there's probably not a lot of guidelines out there, but what are you hearing? What are you seeing on that front? Is there anything out there that is because I get a lot of people that are asking about refinancing.
Yeah, and the thing is, most of those people are not the ones that are in forbearance. The people that it would be helpful for is think about the people who called and they weren't sure how their job was going to play out, how their income was going to play out, and they asked for forbearance, but they made their payment for both of those months. Those people are going to be fine because there's no arrearages, nothing to be made up, no repayment plan or modification to get into. So those are the ones that are most likely to be positively impacted in the short run. Now, over the next 3 to 6 months, hopefully the economy recovers. We get past this, people get back to work, and then, yeah, they can go, okay, my income has normalized back to where it was. I talked to my lender. They're going to add X to my payment every month, and I've made 3 of those payments. Now I can come back and refinance. The biggest thing that we were kind of hoping for, my partner Scott Shang wrote a really good article on one of our websites, findmywayhome.com, making suggestions to Fannie Mae and Freddie Mac of what they could do. And one of those things is, why don't we just allow homeowners, you miss 3 payments, that you can add those 3 payments into the new loan. It's better for the servicer. They don't have this modified loan or a repayment plan. Better for the borrower. Most people have a good chunk of equity. You know, the last 3 years, 5 years, 7 years, if you've owned your home, you've built up a chunk of equity. Right. If we get you current using that equity and back with a performing loan at a lower interest rate, that truly is a win-win for everyone. And that's not written in the guidelines as we see it right now. I wouldn't give up on that, but it's just not there right now.
So let me clarify just to make sure I understand what you're saying, because I'm not even sure I do. So as it is right now, if I defer those payments, say to the back of my loan, because that is now an option, or I set up a repayment plan or whatever, and now my loan is considered reinstated, am I in a position to take cash out and pay off that deferral and pay off those missed payments? Or am I literally just doing a rate and term refinance and everything is still in the, being paid off to the maturity of the loan?
The guidelines are a little bit gray on that, but what you can't do is, let's just say right now you haven't got into a repayment plan, you missed 2 payments and otherwise are totally eligible because we don't have a late payment or any of that fun stuff. We can't do a new loan and pay off that to reinstate the loan. Now, the guidelines are a little bit gray on, let's say we get 3 months down the line and they put you in deferral, put it on the end of the loan, and you made 3 consecutive payments. Now, is that just part of our total payoff and we can pay it off? My guess is yes, but what you can't do is that lump sum to bring it current right now.
Got it. Okay. So what you're saying is that, I've still got to make those 3 consecutive payments before I'm even eligible. What you're talking about is, being able to be eligible before those 3 payments are made and just pay it off through the new loan.
Correct.
Right. Okay. Just want to make sure I was clear on that.
Yeah.
Lastly, what are you seeing in the market right now with regards to loans, to rates? I know we think rates are trending lower. Are things opening up at all? Things getting tighter, taking longer to close loans? Where do we stand?
No. So what you have to remember is, before coronavirus got to the US, it was a big deal in China and markets were looking at that, and rates had dipped to really low levels. So in February, before everything got shut down, we had a ton of volume. I say we, not just me, everyone in the mortgage industry. So everything was super backed up. And then on top of that, everyone got sent to work from home. It slowed things down even more. So now we have 6, 8, 12 weeks of people used to working from home. A lot of that volume has worked its way through the system. So turn times are better. I looked at our numbers, the 3 months prior to coronavirus really impacting the market, we were at about 26 days on an average close. And the time since then, we're at about 32 days. So we've been able to do a really good job. It's been harder work and having more effort to close in 32 than it was getting the ones done in 26 days. But for the most part, the market's normalizing. You should be able to get a loan done right in that 30-day time frame. We definitely are seeing things loosen up, in that lenders were just really scared when this first hit and started adding a lot of guideline overlays. So, an overlay is something that doesn't come from FHA, VA, Fannie Mae, Freddie Mac. It's lenders themselves say, hey, that's great that the agencies are okay with that. This is what we're okay with that with. And we had a lot of really stringent overlays, and a lot of those are getting peeled back. Some of them are still there. Probably the people that are most impacted by those overlays that are pretty consistent from lender to lender are self-employed borrowers. We're having to show that, hey, great, you're self-employed. A letter of explanation as to why your income wasn't impacted, and then proof that you're receiving deposits to your business account equal to what your income looked like. So that stuff's still in place. But some of the overlays of not allowing you to use rental income to qualify because we didn't know whether tenants were going to be paying. Some of the egregious, like some companies that were at 660 and 680 for FHA and VA loans, are backing down to about 640. So still definitely tighter than we were 90 days ago, but thawing, getting better. And probably we've talked about the big difference in interest rates. Interest rates are for the most part flat. They're a little worse than they were 2 weeks ago. And the reason why I kind of pause when I say that, we are used to looking at how mortgage-backed securities trade in the secondary markets and that telling us the direction of interest rates. So what I'm saying is prices paid for mortgage bonds in the secondary markets are a little bit lower than they were over the last 2 weeks. But largely for the most part, lenders have eaten that because we're talking that spread is already bigger than normal. They've just sort of absorbed that. So the spread's a little bit lower than what it was 2 weeks ago, though still much higher than what it has been historically. So for the most part, rates haven't really changed. It's super frustrating for us. The media loves every Thursday when the Freddie Mac primary mortgage market survey comes out to quote, rates hit an all-time low.
Right.
If we go back and look, it was 3.37 2 weeks ago, and it was 3.35 this week. Yes, rates hit an all-time low, but they didn't move in the last 2 weeks. 0.02% is not noticeable to a borrower. So for the most part, it's been Groundhog Day for us in terms of interest rates for going on 10 weeks now. The Fed is buying the vast majority of the mortgage-backed securities in the secondary markets, or if not the majority of them, enough of them to keep support under the market and keep us in a very narrow, boring trading range. So until something breaks out of that trading range, we can, for the most part, just say rates have been flat at really good levels.
Got it. So we're just over 21 minutes. I mean, I think we covered the main things that we were trying to cover here. Is there anything else you want to add to this? Anything that's in your world that we might have missed?
No, that's the big stuff. We're going to be doing a couple presentations for a few real estate offices this week, just in terms of the direction of interest rates and home values. So like you said, we're already at 22 minutes. Maybe next week we can pick up and cover some of what we're going to go through in that class for the realtors.
Awesome. So as always, guys, if you're watching this, do us a favor. If you have questions, comments, put them below. Again, I go through all of them. I reply to everyone. And if you want to reach out to us directly, you can do that through email, which will be provided below, or any of the interwebs as well. So, I appreciate you watching. I'm sure Josh does as well. And we look forward to seeing you again next week.
Thank you, sir.